market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Trump offered a defiant defense of his economic record, declaring the U.S. is back bigger, better, richer, and stronger than ever before in his annual State of the Union address. Well, Bloomberg's Washington Deputy Bureau Chief Laura Davison is with us. Laura, did the president have many new policies for U.S. voters? And good morning.
Good morning. He did not have a lot of new policies for voters. This was a record-long speech, the longest ever in State of the Union history, but it was very much light on the details. He did address tariffs, vowing to press on with tariff policies, despite the loss in the Supreme Court just about a week ago. He also talked about Iran, saying that he hopes to find a diplomatic solution, but was also was not shy about saying he was willing to use more force if needed, and had some very pointed words for the leadership of Iran, and that he vowed that they would never have a nuclear weapon. But when it came to the domestic side, what Republicans sitting in the chamber there were really hoping to get was his vision for affordability and for the economy going into the midterm elections. Those ideas just weren't there. Trump touted the strength of the economy, touted his tax cuts from last year, but didn't have any ideas going forward. There was really only one small measure. He talked about a retirement savings plan addition. That's actually something that was passed under Biden and set to go into effect next year. So it's not even something that is Trump's own idea. So those who are looking for sort of a reset going into the midterm elections will likely be sorely disappointed.
Laura, thank you so much. Bloomberg's Washington Deputy Bureau Chief Laura Davison. Now, comments by AI startup Anthropic have reassured investors following the scare trade that's been pummeling software companies. For more, we're also joined by our Bloomberg senior market strategist, Neil Kaplan. Neil, thank you so much for joining me again. Look, sentiment, seems to change day to day, if not hour by hour. So what did you make of Anthropic's comments, and what are you expecting from Nvidia?
I think the first thing is the reassurance from Anthropic is primarily because they're working with partners, but actually the agentic layer of software is still an unknown as to who's going to be the winner in that race. Software is way oversold on technical levels. That's why you had a rebound yesterday. The market now turns to obviously the bellwether. As we know, Nvidia, we expect Jensen to deliver an upbeat message as per normal. But the question that investors probably really would love to see is, can we get another mic drop moment? Like in May 23, when they guided 50% above the street for revenues. That seems unlikely, but the stock has underperformed, as you mentioned at the top of the show, relative to the semiconductor index quite significantly since the Nasdaq highs in October. But they really need something amazing, if you like, to push it on from here.
Because right now they're like propping up the U.S. economy all on their own.
Absolutely.
Neil, thank you so much. Our Bloomberg senior market strategist, of course, specialist on AI, Neil Kaplan. Now, coming up, we discuss AI investing and private markets with Bruce Flatt, the chief executive of Brookfield. That's next, and this is Bloomberg. Welcome back, everyone. Now, the tech industry is increasingly fused with the world's biggest financial players. Nvidia, for example, has multiple business ties with Brookfield. The investment giant is racing to finance the power, hardware, and infrastructure that's driving the artificial intelligence boom. Now, the firm estimates that AI will require some $7 trillion in capital investment. But on the flip side, the tech revolution is also hitting the valuation of sectors like software, forcing private markets to reassess their exposure and deal making. So I'm excited to discuss the outlook for private equity and credit with Bruce Flatt, the chief executive of Brookfield Corporation, which has more than $1 trillion in assets under management. Bruce, this is our annual catch-up in London, and I always look forward to it. So thank you so much for coming on. How concerned are you about some kind of contagion from private credit into broader credit markets?
Look, I think we all have to, when all these things get brought up in the news, we have to step back from that and just think about it in a much more broad global perspective. Yeah. Private credit's very small, and software loans are even smaller. Mm-hmm. And in a global situation, the credit markets are very, very large, and this is not a systemic issue. There's only really two things that can bring the world down from a systemic basis, yeah. And that's bank balance sheets, and they're in excellent shape, and real estate loans, and housing in the world, and it's in excellent shape. and the consumer is still able to pay all its mortgages. So neither of those are systemic issues. And so I think we just have to step back and think about it into perspective. There's always, with revolutions or evolutions that are going on, it's never a straight line. And we just have to, there will be ebbs and flows on the way to what's going to be an incredibly productive era that's coming with the new technologies that are being developed. And it's been going on for 30 years. It may be going faster today, but this is just a continued evolution of what's been going on.
But Bruce, so why do you think the market seems on edge, right? You're right. So is it because they're worried about AI being systemic? Is it just there's too much money out there? They don't understand private credit? Like, why is everyone so on edge?
Firstly, I just think the world is always thinks it's the worst time at the moment. And when you've been through these before, they're always the worst. But I can tell you there's been 15 worse ones in even my career. And therefore, I think we just need to step back, put it in perspective. This is not that big of a deal. So
this is not a rerun of 08? Or in the run-up of a rerun?
It's definitely not of 08. Like, it's got nothing to do with 08. Now, will artificial intelligence affect some companies, and will some companies or loans to some companies be not pan out as they were expected, or multiples were paid too high for some businesses? Yes, that occurs in every cycle, and probably in 20 and 21 there were companies. We weren't doing it because we don't make software acquisitions or loans by and large, but there's always some of those things that come about. But this is not that big of a deal for the financial system. I think that's the most important thing, that the news gets wrapped up in small things that seem to be of the day.
People are fearful, right? And I can't point to what people are fearful about.
You know, I think it's just change. People always are worried about change, and we're going through faster changes today than we've gone through before, and they keep change keeps getting more rapid all the time. And but I would go back and say, like, we've been building the backbone of the global economy for 40 years, and we do the exact same thing, except the type of things that we're building today are just different. Before, it was water systems and pipelines and toll roads, and then it was telecom towers, and now it's data centers and AI factories, and it's just the backbone evolves, and I think people just get unsettled by that.
I mean, do you think what happened at Blue Owl signals something broader?
No. Look. Again, just step back. It's a very small. It's a very small component, and therefore, I don't. Firstly, just to be very specific, I don't run Blue Owl, and we don't really make loans in software. So this is not our business. Yeah. But if I step back just as a financial person, this is small relative to the global markets, and we shouldn't get too wrapped up in it.
Okay, I want to get back to infrastructure and some of the deals that you put together. But do you think the industry should reconsider, I guess, opening some of the private markets to retail investors, given all of the anxiousness out there?
So the first thing is, remember, all the money in the world is owned by retail investors. It sometimes, and who we've managed money for in alternatives before, is pension funds who manage money on behalf of individual investors, an insurance company who manage money on behalf of individual investors. And now what's happening is the world is just desegmenting that and going to open up 401ks or alternative accounts in a different way. And that's all it is. And what I would say is, and we've been very careful to make sure because we're building this business for the next 100 years, and very careful to not make mistakes along the way of getting to opening up retail. But everyone's learning what those structures mean and how to make them. And so I think it's just a learning process. And of course, there are some mishaps along the way, but it's not a big deal to the overall financial system.
So you've been very acquisitive, and again, you've laid out the vision pretty clearly, which is, we build for the longer term and we invest in the economy of tomorrow. Is there anything that you're missing now that you want, where you think the economy will change, that you need a piece of?
You never know what's coming. Like we coined 3 Ds, or somebody coined, might have been us, not sure, many years ago, and that was deglobalization, decarbonization, digitalization. And even in the 7 years since we've been talking about those 3 Ds, the nuance, we've slightly changed each one. Like digitalization was really about building for cloud, and today it's building for AI factories. And decarbonization was building clean power, and today it's about building any possible power we can build, because we need more power. And deglobalization was about building in the United States, and today it's about building in many different countries. And so I think it's just, there are nuances of change, and you never know what comes exactly tomorrow. But what I'd say is, what's happening today is we're laying the fundamental backbone of the next layer of infrastructure. And artificial intelligence and the infrastructure to drive artificial intelligence is really just the toll road or the pipeline or the water system of yesterday, and it's of today. And that's really what's going on today, and it's being laid by countries, and we're helping some of them do it, and it's being laid by the big technology businesses because they have the resources to be able to do it.
Bruce, there's so much private capital going into building these AI data centers right now. What if demand doesn't live up to expectations?
Well, firstly, anything that we're doing is contracted to a country or a company. So that's their risk, because when we start these developments, they're contracted. So that's the first point, and that's the big difference from people. People reckon back to when they were laying fiber in the .com era, and those were, you laid fiber and you hoped a customer would come. Today, what we're doing is we're building AI data centers for countries and companies, and the countries are creditworthy. I hope so, and the companies are like countries. These are enormous companies, and really they come to us because we have the resources to be able to help them facilitate the build-out of power, connectivity, data center buildings, and wire them inside. And that's really why they come to us and some others like us. But this is an enormous build-out of the next layer of infrastructure in the world, and that's really all it is. And this time it's being led by the best of the world, and therefore the credit capacity is there. And in the private markets, there are no issues. In fact, the only issue is, can we build them? Like, we just can't build them fast enough because the demand is so large. Now, your question was, will it pay off?
Yeah, or is there too much capacity? I mean,
there is not too much capacity. We can't build enough. But the question is, will it be profitable for them? And I think it will be. And what we're seeing in our industrial businesses is being able to use artificial intelligence in very innovative ways to lead to productivity advances, I think, which will be probably the most productivity advances ever seen in a shortish period of time in the history of the world.
I mean, you're such a big player in the space. Would you ever spin off the unit? How do you see Brookfield changing in the next 5 years?
We've spun a lot of things off over the years. We sort of stopped doing that because people thought we had too many of them. We're reconsolidating a number of our businesses on the public side today, so probably not. And we've got, the structure is actually pretty good today, and we're cleaning it up.
So how do you say, are you trying to morph into this investment-led insurer? And how, what kind of timeline are you looking for that?
So our main holding company up top, Brookfield Corporation, we really have 3 businesses. Our asset management business, which is separately traded, and then we have our insurance business and our investment business. And we're really just pushing the 2 of those together because we have $170 billion of capital in our investment business, which is freely available to help our insurance business either be way overcapitalized or to be able to grow. One of those two. And it's probably a combination of the two things. It's going to allow us to grow faster than anyone else because we have more capital than others. And secondly, it allows us to be way overcapitalized, which gives us much more flexibility than most similar groups when you have excess capital. So we can, instead of, like in the last 24 months, we haven't been putting a lot of money into credit. We've been investing in our equity strategies. Right. We just hold lots of cash. Right. And we've been investing in equity strategies similar to what Berkshire Hathaway did for years. And that's sort of the model that we've been tending towards.
So it makes you more flexible, I guess. Flexible and more profitable.
The number one thing in investing is to have flexibility and not be defined in what you have to do. And by having more capital and allowing your balance sheet to be flexible, it allows you to be creative, innovative, and to assist people achieve their goals. And so our whole goal over time has been to have as much capital and more capital than any other competitor we have so that we can do things that others can't. And it just allows us to help our clients, customers, institutional investors, counterparties, do things that others may not be able to do with them. And it doesn't always work that way, but it just helps you be better. And we happen, for 35 years, we've collected capital. Yeah. We've paid a small dividend. We've collected capital, and that allowed us to have a very large balance sheet. And sometimes people look at it and say it's overcapitalized. But the fact is, there are times when excess capital is extremely valuable, and it allows us to have the confidence to do things that many others can't.
M&A? So Oaktree is fully integrated now.
We're shortly closing the Oaktree transaction. We did it in a very staged process over 6-7 years. People businesses should be assimilated over 7 years. We've got to know all the people, and all the strategies today are going to run like they've always run. Yeah. But some of the functions in the back office will be put together. But really, they'll just run like they have for decades. And what we have is two brands. We have two amazing brands. We have an Oaktree brand for really opportunistic credit. And we have the Brookfield brand for global infrastructure and all the things that we're known for.
Do you have appetite for another big acquisition?
You know, I'd say never say never. I never say never. We never say never. But these are people businesses, and they're you need to be very careful with people businesses. So
in terms of culture or integration?
Yes, it's all about culture. Remember, we have in our investment business, Oaktree Brookfield is 4,000 people. Yeah. You need to be very careful with every person and your culture and what you do, and it's very, very important. So this is not like we buy $100 billion of businesses annually in our investment funds, and they're normally assets. You buy a pipeline, it doesn't really argue with you. It has 75-80% margins. Yeah. There's very few people in the business. Your pipeline can come and go. It doesn't argue. Yeah. When you buy an asset management business, it's about people. So there may be an opportunity. Why we keep excess capital is because it's amazing what eventually comes around. And if you sit and wait, opportunistically, there's some incredible opportunities.
But is there something that you would, at the right price, love to buy, given all of the uncertainty?
There's many things in the world that we'd love to take a look at. Often they're not available, or they're not at the price we would pay for them. So we keep lots of lists.
Okay. You won't tell me your top three?
Definitely not.
Talk to me about succession. So how, you've always been quite prepared, right, in terms of succession plans. Like, what kind of timeline can we really look at? What will you do next?
So first I'd say the number one important thing in a business is people. In every business, especially in an asset management business, it's about people. And secondly, our business is about building businesses. We buy businesses, we help the management teams. The number one thing we do with them is plan the people side of the businesses. And we focus on our own business the same way. And therefore, we've planned for long periods of time. We just Teskey became the CEO of our asset management business. I had been the CEO since we started that business. When we spun it off, we thought it was appropriate for me to be the CEO just to have it start that way. He's run the business for 4 years. So nothing really changed overnight because he always ran the business. But and I'm going to do the same things for him that I did to today. I help out on investments once in a while. I look after some clients, and I help with strategy.
So you're not going anywhere?
I am not going anywhere, unfortunately.
Why, unfortunately? you like
some people
you do,
maybe
right?
Some people maybe want me gone.
Bruce, I mean, there's just so much news day in, day out. How do you keep a level head, right, and focus on your long-term strategy when you say everything that's happening with trade and tariffs, with, it could be U.S. policy, what's going on in Japan? It just feels very unsettling.
Look back over 50 years, look back over 30 years, look back over 20 years, look back over 10 years. The world is better today than it was. When you look out 10, 20, 30, 40 years, it's going to be better. The advances that are being made in medicine, the advances that are being made in technology, the advances that are being made in the world are making us more productive, better, healthier. We're going to live longer. We're solving many, many issues that are in the world. So the world's getting better. So if you look at the, we always focus.
Yeah, because people don't feel it.
People focus on the short term.
Yeah.
I'm positive 15 years from now, they're all going to be better off. All is a strong word because there's always winners and losers. Don't get me wrong. But for those that persevere and can look to the future, it's going to be better. And you asked me how we think about it. That's how we think about it. We build the business for the long term. Remember, the money that we invest is invested for 10, 20, 30, 40, 50 years. So this is a very, very long-term business. We don't think short-term. We have to think long-term.
Do you worry about getting caught in the crosshairs of geopolitics?
No, we operate in 50 countries. It's really 25 in a major way. And we're a local player in every single country. So we go to a country, we invest capital. Remember, what we normally do is we take money there from found around the world. We take money there. We buy local businesses. We provide local services to either individuals or to companies. We don't really trade over borders. Once in a while we have a business that does, but by and large, we don't trade over borders. We provide your fiber to your phone. We provide the telecom towers. We provide the office space. We provide we provide services or goods to you in your country, and therefore we're just a local player in every country. So the geopolitics, it affects everyone. I'm not trying to make light of it, but our business is about local business in local countries. What's really important to us is we pick our countries right.
Bruce, thank you so much. Bruce Flatt, you'll have to come back to finish that sentence. Bruce Flatt, the chief executive of Brookfield Corporation. Coming up, we'll discuss the outlook for global trade and tariffs. We'll be joined by Rick Deverell from Macquarie Group and George Saravelos from Deutsche Bank. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump defends his economic record in his State of the Union address, with polls showing Americans are anxious about affordability ahead of the midterm elections. Anthropic says it wants to integrate with companies and not replace them. The AI rally is now waiting on Nvidia earnings later. And UBS says private credit could see default rates surge as high as 15%, 2 percentage points higher than just 1 month ago. So President Trump has focused on the domestic audience for much of his State of the Union speech, boasting that inflation is plummeting and incomes are rising fast. The president also defended his tariff policy after last week's Supreme Court defeat. Well, with us now, Rick Deverell, Macquarie Group Chief Economist, and George Saravelos, Global Head of FX Research at Deutsche Bank. So thank you both for joining us. George, let me start with you, because just last month you were kind of in the crosshairs of the Treasury Secretary Scott Bessent for something you said about U.S. assets. I mean, has it been a long month?
Well, 4 weeks is a long time in markets every year. But what I would say is the episode really reaffirmed the importance of research independence at Deutsche Bank. I got tremendous amount of support from clients, from internal colleagues, and it just really energized us to keep doing our job. It showed the importance of research.
You started this year neutral on the US dollar against the dollar. Has anything changed?
Well, we've been neutral on euro-dollar specifically because it just had such a big move. But as far as the broad dollar goes, in terms of emerging market currencies, the renminbi, we've still been bearish on the dollar there, and the broad dollar is weakening. It's just you're seeing rotation. So we're keeping that view. There's lots going on, as you said, and we'll see how the year develops.
Rick, what's your take on, dollar kind of changes everything. And I don't know whether there's appetite for the U.S. administration to have a much weaker dollar or whether actually they think it's okay.
Yeah, it's interesting. If you look at the real effective dollar, it's still very expensive. It's tended to move in big cycles since Nixon left the gold standard in 1971. So even without the Trump administration, I think it was at the levels that you'd normally expect now to have a bear market. Mm. And I think the Trump administration is adding to that as people think about diversifying. So, I'd be very surprised if the US dollar is not weaker in 5 years' time. Of course, the next 3 months is much harder.
Yeah, George, again, because you've written so much about foreign investors diversifying away from the dollar, either through FX or asset allocation changes, are you seeing that come to fruition?
Well, there's a very interesting dynamic going on in the market where you're seeing European investors de-risk. And, of course, this is relevant in terms of FX hedge ratios, but also the broader relationship, if you're seeing the ramp up in defense. But in Asia, we're yet to see that dynamic. Asia is, I want to say, doubling down in U.S. exposure. You can see that in Taiwan with some of the changes in hedge ratios. Japan, the Takaichi-Trump relationship is very strong. And I think how that dynamic plays out, because we've seen dollar weakness against European currencies, and in Asia that's not happened yet. So to see another big wave of dollar down, you really need to see the Asia investor behavior changing, and that's what we're very closely monitoring this year. It's obviously related to how the BOJ behaves, all sorts of other things going on, but Asia versus Europe, I think that's quite important.
And I know you said, look, it's so important to have independent research, but why is it so difficult to write about things like this at the moment?
Well, I think as long as you write solid analysis that tries to be objective, is focused on markets rather than politics, I wouldn't say it's that difficult. So we keep writing, and clients like to read us.
Do you see, Rick, any asset allocation changes? As from a chief economist point of view, do you see a big shift in the next 4 to 5 years? Are you starting to see, shifts now because of gold and some central bank reserves, or is it just little things that are unquantifiable for now?
Yeah. So I think a lot of clients that I speak to would like to diversify, but it's actually harder than it first appears because it's the biggest and most deep market. So I think it's at the margin, and I think it's slow, but I think it will happen. And if you look at things like the MSCI, the S&P was trading at a similar multiple to the MSCI World ex-US 10 years ago, and now the multiple is almost double. So they're also very expensive. So I think you put those two things together and there's an incentive to move. I just think it's actually quite hard to move in size quickly. So I think it's more of a multi-year process rather than something that happens fast.
But what's your biggest concern right now? Again, I think George was pointing to the fact that there's a big concentration of AI risks in the U.S. There's a lot of uncertainty on trade and tariffs. There's, you don't really know how chief executives will behave, or actually the impact that AI will have on macro. Is it all of the above, or is there something that we're not seeing?
Yeah, so again, it's interesting in that it's the kind of period where people like to focus on the negative, and there's a long list of things that could go wrong. But I think we've got to recognise that most of the time it goes right. And the last year has been a classic point again in that there's lots of things that could have derailed the global economy, but it's actually been once again more resilient than people thought. And as we're going into this year, I think it's speeding up rather than slowing down. So in the near term, I think we'll talk about these issues a lot, but I think the economy will be fine. But I do think you're building imbalances. So what normally drives a US recession is a bust in business investment. It's not consumption, because business investment swings more heavily. And clearly we're having a very big surge in AI investment at the moment. And if that goes for another couple of years, which I suspect it will, at some point the market will probably say enough. Yep. And that'll pull back, and that'll be the downturn. But I don't think it's this year.
But, I mean, again, this was a key concern of yours, George, right? The fact that there's so much concentration of AI risks in the U.S., and we're now seeing actually equity investors struggle to price this and price the impact across several sectors. So is this going to continue, or does it get settled at some point?
I would say it's probably likely to continue because just uncertainty is so high, and we're talking about a transformational technology. But as far as the global market goes, to me, the most important dynamic is for the first time in a while, these risks and the high volatility stemming from the US rather than the rest of the world. And that has dramatic implications for the relationship between the dollar and equities. So when the risks are centered in US equities, the dollar stops behaving as a safe haven, and it's something we've written about for a while. And then what that means is it reduces the incentive to hold equities unhedged. You want to remove the dollar equity exposure. Now, if you look at the rest of the world, it's something Rick mentioned as well, for the first time we're seeing good growth. So global data surprises have actually been positive now for more than a year. We continue to get good data, and I think that's where you're seeing the growth convergence as well. So the overall global story is actually quite good.
But what are you expecting from the Fed? And again, I guess does AI impact inflation or just the labor market longer term?
Well, the two would be related. So I think if you get the really fast, disruptive story, it would be disinflationary. As far as the Fed goes for the next 6 to 12 months, my view has been that they're not going to do anything. As I say, they're in a good place. The market is obviously very focused on the wash transition. But if you look across the world, you've got very few central banks that are moving. One exception is Australia. But most of the central banks, the ECB, G3, they're not really going to be moving this year, which I also think is helping keep vol quite low, despite all these risks we're discussing.
Rick, what are you expecting from the Fed?
I agree. I mean, I think that inflation...
A consensus around the table.
We really shouldn't do that. I know it's bad, but inflation's 3%, unemployment's very low, the labour market looks like it's rebounding, so I think they sit and wait. If they were to ease, I suspect it to be a mistake, and they'd have to take it back later this year. So I think they're just going to watch for a while.
How do you think about AI? Because I see reports say, it's 300,000 job losses. I think it's so difficult to actually have a comprehensive reading because...
And it is hard because there's so much churn in the labour market every year. So last year, for example, there were about 60 million people changed jobs. Mm-hmm. So when you have a big announcement, big companies shedding 20,000 jobs, that's terrible. But in the scheme of the size of the US labour market, it's actually not very big. If you look at the labour data, again, it's been interesting in that most sectors in the US economy were on a very stable trend between 2010 and 2020. COVID happened. It's really scrambled things. And there's been a lot of diversity since then. And a lot of them have fallen away from the trend that you saw in terms of employment growth in that period. So something's happening. But at a macro level, it's not clear yet that we've got a lot of productivity coming through at an economy-wide level. If it does come, which I think it will, most of the theory would say that's higher neutral rate rather than lower neutral rate. Yeah. So like Kevin talks about Greenspan in 96, what people have forgotten is Greenspan didn't cut rates, he just didn't increase them. And the real 10-year in 1996 was double the rate that it is now. So it's actually quite ambiguous again whether it actually leads to lower rates or higher rates.
Do you expect, I just had a good conversation with Bruce Flatt of Brookfield, who's saying, look, he doesn't see anything systemic in terms of, private credit or credit markets. Do you worry about something really upending our economies?
Yeah, and again, it's on the list of things that could go wrong. And because it's private... But
it would be systemic?
I don't think it's systemic, and that's the key thing, because the problem is we don't have enough information on what's happening there, so when it's in the dark, bad things can happen. But it just doesn't look big enough. No. Now, famous last words, it could be, but it's not something that I'd put in the top 5 things to worry about this year.
Do you worry about it, George?
I think in the long term, it's definitely something to worry about and think about. It's one of the most interesting questions in my career, given the transformation of this technology. But I think it's very important to not just focus on the technology itself, but also the political economy. And I have to go back to reading Marx, to reading Keynes, when we're thinking about how these technologies transform the distribution of wealth, they impact on the unemployment rate. So if you go back to these big rollouts of technology in the 1900s, even in the 1800s, it was all about distribution, and it was all about institutions. And I think we need to keep that perspective. So to answer the question on, is it systemic, is it deflationary, are you getting the fiscal response? How are the politics responding? What is the impact on elections? And I think that's what makes it really fascinating over the next few years.
So Japan, I want to talk to you about Japan because it gave us a little bit of, I don't know if it's a fright, but sort of a roller coaster ride. So what does the new PM with a massive landslide victory mean for yen?
Well, I think the first thing is she has a lot of authority. As a starting point, I would say our approach in Japan is that there is no systemic debt issue. We look at Japan in terms of consolidated balance sheets. We look at the external sector. And therefore, when you're looking at the dislocations in the back end, they look a lot more technical. Japan has the capacity to service its debt. It's all about the policy choice. It's about allowing the Bank of Japan to hike rates. We've seen some stories overnight as well in terms of some of these appointments were dovish. And I think we're quite cautious on the yen because to be thinking about the large rally that would make sense, you really need to see real rates going up. And at the moment, it seems to be that the government is favouring a policy of low real rates, which allows debt to GDP to go down. It's effectively a form of financial repression.
We've seen so much volatility across markets. Are you expecting more or less volatility for the FX markets?
Well, it's an interesting question because I'd say we're seeing very localized volatility. So you saw it around Takaichi, you saw it around some of the headlines with Davos. But if you take a step back, implied volatility is very low. Emerging market volatility is extremely low. Carry trades are doing well. In all the work we've done, the single most important driver of all is growth. So going back to the previous discussion we're having, if the market perceives growth risks to be relatively low, especially global growth risks, I would expect these vol shocks to be quite short-lived and carry to continue to do quite well.
In terms of risks, Rick, how do you think of China? Because, again, there was a line of thought that we were going to import deflation from China. That's happened at the margins, but actually very little. I don't know if we spend enough time thinking about China, given everything that's happening in the U.S.
Yeah, and it is interesting in that if you step out of the noise and you look at particularly the U.S., but also Australia, it's too much inflation, not too little. So, again, there's this bizarre conversation going on where people are worried about AI taking the jobs. At the same time, you go to places like Europe and people are worried about sluggish productivity. You can't have both of those. And then you kind of throw China in the mix. I actually think China is a source of stability at the moment. China's really interesting in that you've had the tariff shock, but exports are actually driving the economy at the moment. So, again, there's a perversity there. If exports were to falter, which I don't think they will because I think we've got a global recovery happening, I think then they'd turn the dial and they'd stimulate the domestic economy. So they're happy with 5-ish% growth. If it comes through exports, that's fine. They'll allow the property market to continue to deflate. But if suddenly they needed to change gears, I think they've got capacity to do it. So I don't think China's going to be a source of big volatility this year.
Why is it so difficult to you both to actually, price in geopolitical risk?
The problem with geopolitical risk is if you look at the very long run of history, lots of bad things happen in regional areas and it doesn't really do very much to global growth and to global markets. So if there's an oil shock, obviously it impacts the oil market, but unless the price moves a long way and stays higher, it doesn't tend to have a lasting effect on other markets or on the economy. So, again, there's lots of things that could go wrong, but in my judgment, the kind of things that we've seen so far are localised issues, very bad for the regions involved, but none of them have had a significant impact on the global economy or on global markets, and I don't think that's going to change in the next year.
I mean, it feels like, and again, there are bouts of volatility that, the markets have largely ignored the Supreme Court decision on tariffs, again, because it's uncertainty. But I don't know, George, how you see it. We don't know if countries retaliate. We had a response from the EU, but again, we're in flux, and the markets seem to be moving on.
Well, again, this Supreme Court decision is an interesting question. We've long been of the view that the market reaction would be very limited because if you look at the noise versus the reality is that the administration is going to be able to pivot to effectively something very similar. Now, it may well be the tariff rate is 1 or 2% down or up or down, but from a big picture macro perspective, it's not really going to change anyone's view unless you're assuming much bigger changes to tariffs, which don't seem to be going through. So again, you have this divergence where the headline uncertainty is very high, but if you're looking at the macro impact, and again, another example would be you're talking about headline tariffs of 16, 17%, but if you're looking at realized tariffs, they've been closer to 10%. So again, the impact is smaller than some of the headlines would suggest.
Yeah, and again, unfortunately, we agree. I mean, the main thing that happened last year is taxes in the US went up by about 1 percentage point of GDP.
Yeah.
So tariff revenue went from 0.3% of GDP to about 1.3. The fascinating thing about the Supreme Court ruling is that I think it's really important for things like credit markets because it shows that the guardrails are holding. Yep. So, the famous US system is still working. But in terms of the macro impact, this year, fiscal policy was moving from being tight last year with the tariff increases to being easier with the one big beautiful bill. At the margin, this probably means there's less tariff revenue and there may be refunds, but it's very much at the margin. So you wouldn't change a macro forecast based on the changes in the tariffs, at least as we know them at the moment.
Okay, thank you both for joining us. Rick Deverell there, Macquarie Chief Economist, and George Saravelos, Global Head of FX Research at Deutsche Bank. Thank you so much for joining us. Coming up, the AI scare trade has rippled through global markets. To discuss how venture capitalists navigating the boom, we'll be joined by the president of General Catalyst Institute, Teresa Carlson. That's next, and this is Bloomberg. Welcome back, everyone. Now, AI has triggered weeks of turmoil in the markets and the so-called scare trade. To get insight on how a VC firm with portfolio companies, including Stripe, Mistral, and Airbnb, navigates the age of the AI boom, I'm joined by Teresa Carlson, president of General Catalyst Institute. Teresa, thank you so much for joining us. I'm really excited to speak to you because you've been in AI and technology-related companies for a long time.
Yes.
So, I mean, what worries you? Is it the adoption? Is it the demand, or is it the China versus U.S. race?
I'm more of an opportunity person, so I think about what's the opportunity. And when you think about the opportunity, we want to think about what are all the elements to make this work, right? Not like what are all this kind of scary things. I think this week has been actually a pretty good week because you're seeing, because of some of the releases like from Anthropic, a new level of confidence in the productivity and what can actually happen with AI. But when it comes to making it a reality, one of the big things that we focus on at the General Catalyst Institute is the policy side. Because believe it or not, if you don't have all the right policies in place, all these things don't actually work. So while the commercial companies have to go, right, get the land, get the compute, make sure that there's chips available, make sure that there's energy available, if policies don't line up so these things can actually move faster and there's great adoption, that's what I worry about the most. I would say also we do always have to consider what's going on in China. That we always are considering because we have to move a lot faster. Yep. And you never really know how much is hype or not.
Yeah, I mean, I keep on being told that, China's only 6 months behind a lot of the major U.S. companies. Does that make a difference to how you think about policy and how policy should be implemented?
100%. We always want an unfair advantage outside of China, right? We need to make sure that everything we're doing has an unfair advantage to move a lot faster. And they have this issue of, hey, they're government-led on every single issue they do. So if they say we're going to do it, they move forward. And they also have a very long-term view of this, where we tend to, outside of China, have a shorter-term view on things based on who's in office, right? What kind of decisions are they making? But here's the thing that I think we have in the Western world that makes a really big difference here, which is we have talent, we have capital, we have entrepreneurs that are unbelievable. They like experimentation. They don't mind failure. They pick themselves up faster. And we have the research and academic institutions to really make this work.
Teresa, how difficult is it in 2026 to find the winners and losers, actually, of this new AI revolution? Because everything's moving fast, and I have a lot of chief executives on the show that say, look, I don't really know what model I'm going for, so I'm trying them all out to see what sticks.
Well, AI native, I mean, everything is about AI. When you're investing, we look at so many great entrepreneurs. We tend to invest on, believe it or not, the individual. We invest even on an idea. If we like the founder and the entrepreneur and we're like, this is like an amazing idea, we'll invest in that. So we do kind of pre-seed, seed, all the way through. So if you think of somebody like a Stripe, we've invested every round. I love that you had Minstrel on. They're one of our top investments. But we tend to think about the founder, their idea, and can they execute. But really, everything is about AI native at this point. You've really got to only think about that.
So when do you know who? I mean, is it first mover advantage? Is it first technology? Is it first funding advantage? Like, how do you? This is a completely new technology to what we've seen in the past.
Something that I see that's really different, and this is really based on my experience of years of being in tech, is it's also about ideas that people have that haven't really been thought of yet, and also I'll say. I don't want to call it disruption of industries, but additive. So if you think about a call center or like a traditional real estate business, bookkeeping, record keeping, now legal, you're actually seeing high disruptions of what AI can do when they come in and take that over and really apply AI to it in a very productive way. So we're seeing industries actually take overlays of what we call applied AI and be able to change those industries. So those are also really high net worth opportunities.
Do you think that we underestimate the pace at which the change will happen on AI, or do we overestimate it?
I think we're underestimating it. Because if you see the releases that are happening already with again, I'll take Anthropic. They're all, but I mean, these releases, and people are like, what just happened? I mean, they can't even believe that these releases are coming out. And I remember in the cloud world, we thought that things were moving fast. And now I call it a double strap in, like, get prepared. This is moving so fast that we're actually having a hard time absorbing what's going on. And that has to happen. Of course, enterprises have to be able to adopt this. Governments have to be able to adopt this. So there's got to be training and learning and understanding and skills along with this.
Do you ever worry that there's so much money in AI that is needed to build the infrastructure, the data centers, that there's not going to be enough demand for it?
I don't worry about that. I just think because I've been in tech so long, I think these things get balanced out. Yeah. And also, these are really smart people doing this work. They understand how to do capacity planning. Oh. And the other area that we don't talk a lot about is, why are these models? Why do we keep releasing the models if people aren't adopting them fast enough? But we have to make sure, again, staying ahead of China. We can't let them get far advanced on us, especially because of defense, mission capabilities, financial markets, healthcare, things that we really care about that make our economies resilient. We've just got to be ahead of all this.
Teresa, when you just speak to policymakers across the world, who gets it and who doesn't get it? Because I get, a lot of chief executives, again, from the AI world say, when you go and see politicians, they think about AI, but they don't really understand how transformative this technology could be for their economies.
I'm so glad that you asked that question, because this is literally why the General Catalyst Institute exists, is to go out and work with policymakers and bring our companies to the table so they understand it. And you nailed it. A lot of them, they're struggling understanding the full capability of all these technologies. So we try to walk in and really explain and let them see the companies firsthand and talk about what's going on with finance companies, healthcare companies. We're even seeing things like Physics X, who's disrupted the way you do mathematics and how you, and then if you think about doing virtual healthcare, even in hospitals, all these things are really changing. And the policymakers have to understand how that operates so they can actually create policies to make this move a lot faster.
But I mean, there seems to be a timeline disruption, because if you have to educate policymakers, they could be behind the curve. By the time they understand it, the technology would have already moved on.
Well, always. So that's all. I mean, yes, that's always a problem. I will say, and I will give an example within the U.S., this administration, where they have excelled is on doing things like executive orders to say we are going to adopt this at every level of government. And it's really pushing both commercial enterprises and governments to go out and absorb all this.
Teresa, thank you so much for joining us. Teresa Carlson, their president of VC firm General Catalyst Institute, focusing on policy. Up next, it's Bloomberg Brief, and this is Bloomberg.